afternoon, or good morning, depending on where you're joining us. Welcome to this special Cannabis Conference webinar, IRS Audits, Mistakes to Avoid, presented by Cannabis Business Times and Cannabis Dispensary magazines. I'm Cassie Tomaselli, your host for today, and I'm looking forward to tackling this very important topic. But first, I'd like to make a quick announcement about Cannabis Conference 2022. Cannabis Conference 2022 is the industry's leading in-person event for plant-touching businesses in the cannabis industry. At Cannabis Conference, you'll meet with others facing the same day-to-day hurdles, learn how to overcome those roadblocks, and anticipate the challenges to come during a time when business growth and legalization are intersecting in new markets almost every day. At Cannabis Conference, we'll be host to 90 plus expert speakers, 40 plus education sessions, and 200 plus exhibitors from August 23rd through the 25th at Paris, Las Vegas. Our education program was comprised by our all-star Cannabis Conference Advisory Board, which includes many industry trailblazers. And it was also put together in partnership with our award-winning editorial team of Cannabis Business Times and Cannabis Dispensary and Hemp Grower magazines. Tomorrow is the last day to secure our early bird registration rates before they expire at midnight Eastern time, and you'll save up to $400 off on-site rates by registering early. One special note, participants of this webinar can use the promo code Audits10 to receive an additional 10% off of their registration. Just type in this code at checkout. Once again, it's Audits10 to receive that discount. All of the information about Cannabis Conference can be found at cannabisconference.com. And with that, I am very pleased to introduce today's speaker, Nick Richards. Nick is a partner at Greenspoon Marder, LLP of the Cannabis Practice Law Group there. He represents individuals and businesses in tax audits and trials, mergers and acquisitions, managing tax debt, and he also advises cannabis companies, owners, and investors regarding tax and regulatory compliance matters. Nick has been a tax attorney for more than 20 years, beginning his career with the IRS, where he was a leading trial attorney, a chief counsel advisor, and a special assistant to the United States Attorney. Several years after leaving the IRS, he represented a Colorado cannabis company in one of the first IRS audits in the legalized industry. And since that groundbreaking case, he's gone on to successfully represent companies in many cities, states, courts, and before the federal government. In addition to these tax audits, trials, and collections, he's widely recognized as a leading cannabis industry attorney and has extensive experience in IRC Section 280E and BSA cash reporting requirements. His knowledge of the tax system is essential when advising business owners and investors, particularly in mergers and acquisitions and entity formation. If you have questions for Nick during the presentation, just type those into the questions box or chat below, and we'll get to as many as we can before the end of the discussion. Also, if you need to step away at any time, not to worry. This webinar will be recorded and you'll receive a link to the presentation in a couple days via email. So Nick, at this point, the floor is yours. Thank you so much for joining us today.
Thanks, Cassie. Really fun to be here. Thanks so much for the opportunity, and really excited to talk to, I think, a pretty varied audience today. I think we've got some CPAs on the line. We've got some ancillary business folks, and then obviously some operators as well, and some business owners as well. So really fun group to be speaking to, and I thanks so much for the opportunity. I'm going to share my screen in a minute and get into some PowerPoint slides. We got kind of a lot to cover, so I'm just going to jump right into it. The first slide that we are going to go with is, give me just one second here. Where is it? There it is. Sharing. So today we're talking about IRS audits and mistakes to avoid. And that's me. You guys heard about me. It was flattering. Thank you, Cassie. But let's just jump right into it, okay? I'm an attorney at Greenspoon Marder. We're a full-service law firm. We handle more than just 280E, tax, and M&A. If you have a legal need, we're here for you. We have 25 offices across the country, and I think we're sort of a trailblazer firm in the cannabis space, so really proud to be part of the firm as well. Okay, let's talk about 280E and Bank Secrecy Act audits. So really kind of the first case out there is Champ v. Commissioner. In Champ, it was an AIDS clinic that started selling cannabis for medical use in San Francisco. And the court essentially held that 280E only applied to the cannabis portion of that business and did not apply to the AIDS clinic portion. And there was some other law in there. And from Champ, we also get our definition of trafficking in a controlled substance, which is essentially commercial activity, buying and selling. So we get that kind of seminal case that establishes that, yes, 280E does apply to the cannabis industry. We find out that a single business can be both subject to 280E and not 280E for some of its activities. And we get this definition of trafficking that has continued on in the courts through all the cases to follow. Then in about 2014 or so, the IRS determined that the industry was out of compliance here in Colorado. And they opened widespread audits here in Colorado, and they started what's called a Compliance Initiative Project, a CIP or SIP. And that Compliance Initiative Project authorized the IRS to target the Colorado cannabis industry and to randomly select audits from that targeted industry. And probably 70% or so, 80% of the cannabis companies here in Colorado went through those early audits in 2014. Some of them are still going on and are still out there. As part of those audits, then a couple of years later, in I'd say 2016 or so, we saw Bank Secrecy Act audits. And those Bank Secrecy Act audits occurred both individually and as sort of package audits with the 280E audits that were already going on. I was probably handling, I don't know, 10 or 15 280E audits at the time, and probably half or so of those ended up with Form 8300 audits as well. And so those are the two big areas that we look at in the federal tax compliance world moving forward. And I'll talk about each of those separately. I should just add right now that in any cannabis company, it's not just federal tax audits that occur, but also state and local tax audits as well. And so, we've handled, dozens of state and local tax audits here in Colorado and California, and they're every bit as important and every bit as challenging. Finally, after we saw BSA audits coming out about 3 years ago or so, we saw a TIGTA report come out. And that TIGTA report then talked about the IRS audit programs, talked about these compliance initiative projects, and sort of detailed a little bit of the findings and what they found out and the results of those audits. And most importantly, the results were, fabulous from an IRS standpoint. Essentially, IRS agents working on audits generate something like 3 times the dollars per hour spent on a cannabis company than they do on a non-cannabis company. So the TIGTA report talked a lot about those audits, how great they are, how great results they get, how they could do them better, and how they should do more of them and expand these compliance initiative projects to other states. And I'd say today we are seeing that is happening. We've got audits that we're handling here at my shop for, I don't know, probably in 5 or 6 different states right now, and multiple audits in each of those states. The states that seem to be showing up are Massachusetts, Michigan, Arizona, California, Oregon, Washington. Colorado is still on the radar as well. And there's some other ones scattered out here and there. Those audits are now being handled by agents other than just Colorado agents. For a long time, it was mainly Colorado agents that were handling all the audits. Now those Colorado agents are advising agents in other states. So I have a number of audits that are out of Maine right now with agents out of Maine that are handling them in other states, including all the way on the other side of the US in California. So that's kind of where we are right now in the evolution of this. Honestly, all these cases have been problematic for the cannabis industry in that there's been some sort of theory that's been put forth in these in the various tax cases that have come out of the tax court. And as we'll see moving through those, there's been a lot of sort of pain because of those cases. They're all really losses, but there's been little snippets that I'll try to focus on in this in this webinar that maybe are productive points that we can use in the future. Okay, moving forward. So lessons learned, and this is where we get into some of these cases, okay? So Champ v. Olive, right? Olive is that first case. I'm sorry, Champ is that first case, and Olive are a couple cases that followed up as well. And Olive is both a tax court case and a Ninth Circuit case. I call this area the glass and t-shirts model. And there was a lot of people out there promoting the model as a way to reduce 280E down by taking your, quote, glass and t-shirt space. Many cannabis companies throughout various states are limited in what they can sell, and they can only sell cannabis products, and then the only non-cannabis products they can sell are glass, which are pipes and bongs and stuff like that, and t-shirts, sweatshirts, hats, etc. So this glass and t-shirts model was used to try to qualify for the Champ model. And the Olive line of cases came in and said, look, you can't just take your glass and t-shirts and call that a separate business. That doesn't work because it's merely ancillary to the sale of cannabis, because it is some very small percentage of your overall sales. Let's call it 2% of your overall sales. But unfortunately, you've tried to put, let's call it 40% of your costs on that glass and t-shirt business. And what that does is it renders that business non-profitable. You cannot make a profit in that business because you've dumped so many costs on that business to try to get around 280E that it loses its profit intent. And so the story on this glass and t-shirts model is that it only works if you have true profit intent. Now, fast forward, we've got some elements that make that a little more possible. CBD is now a big product. CBD can have sales that are more significant, that can overcome perhaps that 1%, 2%, 3% limitation that is glass and t-shirts. But then, of course, it still has to have profit intent. You still have to do it right. And a lot of that is around the devils in the details. Get a good professional to help you through that. It may not be worth doing it at all. A lot of sort of business structure and the way in which your facility is able to structure two different activities is also really important in that. Okay, next one. 280E is sticky. It is a sticky bud, right? And it sticks to things. And so there's a lot of folks with every new state out there. There's a new group of discussions around ways to get around 280E. And there's always people out there talking about doing something and pulling a bunch of costs into a new entity, say, for example, and getting around 280E by putting them in a new entity. Guess what? If you drag a cost subject to 280E from one entity to the other, you just drag 280E to that entity. You didn't strip it of 280E. 280E is sticky. You got to be really careful when you do that. And alternative healthcare is a case that held that a management company that was not licensed to buy and sell marijuana, but was just operating a facility on behalf of a licensed company, was itself subject to 280E. And essentially, it's in that classic management company model where you have a management company operating a licensed facility. All of the revenue comes in to the licensed facility. It's paid 100% or close thereto to the management company as a management fee. Management company pays all the expenses, and the profit goes to the owners. It's a structure used in many cannabis companies in early stage states. And the court basically held that 280E applied to disallow the management payment in the licensed company, and also at the management company level as well, because of course there were no sales there, so there's no cost of goods sold. So horrible decision. The gist of it essentially is that if you are a company out there with multiple boxes, and so you've got an OpCo box and then you've got multiple boxes. So for example, holding company, real estate company, management company, IP company, any one of those companies are companies that you are trying to put into your overall enterprise, and have them not be subject to 280E. And it's really, really, really important that that's done in the right way. And that includes both the way that you set it up and also the way that you manage those costs down the road. And you can take the best well-laid plans and turn them into a 280E disaster if you drag a bunch of 280E costs where they shouldn't be. So that's the lesson on alternative healthcare. And a lot of companies that got into that problem early on, we're now helping get out of that problem by getting those costs back where they should be. Next case is a case called San Jose Wellness. And San Jose Wellness, another big loss for the cannabis industry. Essentially, San Jose Wellness was trying to prove that charitable contributions were deductible because they weren't tied to the year at issue or the trafficking of a controlled substance. They were sort of outside of that. And they lost. They were subject to 280E. But along the way, the court said something very interesting. It essentially said that trafficking for purposes of 280E occurs while conducting actively a cannabis trade or business. So it does not apply before or after the active conduct of the trade or business. So that would include startup and wind down that it should not apply to. Now, it's interesting because if you know the way that 280E works and you know the way that accounting methods work for inventory, the fact that it doesn't apply to startup, for those of you who have been handling these audits for a while, you know that that has been true for production assets all along, and that the IRS will allow you to put production assets into cost of goods sold and take those at 1/15 per year as startup. What about reseller assets? What about the build out for your dispensary? Now, if it doesn't, 280E doesn't apply to that, how does that work now that you're in an active business and now that 280E does apply, you don't have a quote deduction? Can you put that into cost of goods sold? We don't know the answer to that question yet. We don't have a follow-up case, but it's something that needs to be on everyone's radar to think about as we move through this. And lastly, today's healthcare, I think, is the most recent 280E case that came out. It's sort of, it's what I say there is that net operating losses are not disallowed by 280E. The case doesn't really say that. But let me say this, the case indicates that an NOL was conceded by the taxpayer. And it looks a little like it was conceded because of 280E, but I want to be clear, it's conceded because 280E was not properly applied in the source year. On a carry forward year, for a 280, for a net operating loss that was legitimately generated in a source year after the proper application of 280E, that NOL can be carried and it is allowed in a carry forward year. So heads up on that. The law, there's a lot of law around that that's very, very well convincing. And this case caused a lot of stir out there around, hey, I got a lot of calls. Hey, Nick, does this mean NOLs are now, we can't claim them? So I want to bring everybody up to speed on that. Okay, so that's lessons learned from current tax litigation. There's, of course, a lot more out there that we could talk about, all the bad things that we learned, starting with that, cannabis resellers, so that's dispensaries, their cost of goods sold is limited to invoice price. That's the price they paid for the marijuana and the shipping to get it in the door. That's the result of Harborside. And it is a real tough case for any resellers out there. Okay, so let's talk a little bit about, okay, thought I might have skipped one there. Okay, lessons learned. Okay, this is just 3 minutes. Most of you should know this already. Okay, what is the deal with forming a company and how does 280E work in the formation and activities of that company? Okay, so we got two general kinds of companies out there. We have companies that are taxed as partnerships. Generally, that is a partnership or an LLC. An LLC can be various different things. It can also be an LLC taxed as a corporation. Most LLCs, though, are taxed as partnerships. So when I say LLC, I'm talking about an LLC taxed as a partnership. Differently, we have C corporations, and C corporations are really the only kind of entity out there that pays its own tax liability. It itself is a taxpayer. It itself is subject to taxes. And so the critical difference on that is that when a C corporation earns income, it pays corporate tax rates on that income before it then pays that out. Differently, an LLC taxes as a partnership, an S corporation, or a partnership, that profit flows through to individual owners via a Form K-1, and that profit then is reported on an owner's tax return. And differently, they pay individual tax rates rather than corporate tax rates. Many times individual tax rates are higher. Corporate tax rate is 21% right now. So what's the implications of that? First off, flow through liability, right? If you are in a company that is taxed as a partnership, the tax of that company is your personal tax. It flows through to your personal tax return, and it is taxed at personal rates. In the 280E world, that means you end up getting a K-1 with more money on it than you actually received, because you get your portion of the 280E disallowed expenses. So simple example, right? If I buy a joint, I pay $2 for this joint. I pay a bud tender to $2, and that bud tender sells it for $5, right? I just made $1, but my tax is going to be $3. I get to take as cost of goods sold the $2 I paid for the joint, but not the $2 that I paid my bud tender. So I get taxed on $3, right? Even though I just made $1. If I'm in a flow through company, I get $1 and I incur $3 of tax. If my tax rate is more than 1/3, I just lost money. And you can vary those different things and see how that works, right? But that's the basic gist of it. That tax liability, that 280E penalty, it's not really a penalty, but that is my responsibility, right? And what does that mean? That means that if I lose my business, guess what I get to keep? I get to keep the tax liability. It does not die with the business. It's my personal liability. Really important to know. Cannabis industry is a tough industry, right? Flow through audits, next point. Because of tax liability, because the revenue, the income, the profit has to be reported on my tax return, I'm the one who's under audit. So if you're in a cannabis company, remember, we talked about the TICTA report. Cannabis companies get audited, right? If your cannabis company is under an audit and you're in a flow through, you're under audit too. And what that means is that the IRS they're required by their Internal Revenue Manual to look for what are called LUQs. In addition to the 280E audit, now they're looking at your personal tax return and they're looking for LUQs, large, unusual, or questionable items. And most of my cannabis company owner clients have a couple of those. And so now you're exposed to audit as well. So that's a big deal in the cannabis space. And finally, in all of this, you need to be thinking about the traditional entity planning points, entry and exit. What is the right entry point? Things that come into play there are investor concerns, licensing, of course, and salaries. Can the owners work in the business? How do you get the money out of the business? All of that kind of stuff is important. And then exit. What's your exit strategy? Are you going to hold this thing and operate it for a number of years? Are you going to sell it? Remember, a C corporation, when you sell it, could be subject to double tax. So that has to be navigated properly as well. So that's the basic gist of it. It's not a thing that you can just, have a list and, one size fits all. It's a discussion. You got to get the right balance between investors, owners, licensing, and taxes all together in the mix. Okay, shifting a little bit on everyone now, and I'm going to talk about this. I'm going to talk about Form 8300. So Form 8300 is a Bank Secrecy Act form that is required to be filed whenever you receive more than $10,000 in cash or cash equivalent. So that cash equivalent is a cashier's check, money order, that kind of thing. So what are those requirements? So first off, that's much like if you took more than 10,000 cash to your bank, they would fill out what's called a currency transaction report or a suspicious activity report. Well, the Form 8300 is the form that businesses have to file when they receive more than 10,000 cash. And note, I said more. It's not 10,000. It's 10,001 penny. Okay. The model then requires certain information on the form itself. And essentially it requires the courier, so that's the individual who shows up with the cash, their personal information, driver's license number, social security number, address. And then whoever that courier is working for, it requires that business's information as well, their EIN, name, address, etc. So those two blocks of information are the critical blocks of information on that form. Now, in the cannabis industry, there's also, actual couriers that are used as well. Hired couriers, you might, as a buyer, have a courier go pick up your marijuana for you, etc., or as a seller. That courier now needs to be reported too. And so that's a pretty technical form, right? What about that? If you cannot report all those items properly, there is a memo line, a memo blocks on that form. You have to fill that out and give that explanation. The form must be filled out. And if it cannot be filled out, it's wrong if you don't then provide the explanation. And finally, that form needs to be electronically filed. Unless you're filing back forms, don't file them paper form. There's an electronic system that you key everything into. And if you file a paper form, now an individual in the IRS is going to take your paper form and key that information in. You don't want them looking at these forms. You want these forms to just go into the system, into the file, check, satisfied, good enough. So file those forms electronically, okay? Now, let's talk about a little bit when these forms are due, right? So in the cannabis space, cannabis sellers, these are manufacturers and producers, are the primary ones that deal with these forms. And a lot of times there's a lot of different customers and they're not consistent as well. And so the rules get a little weird, but essentially here's the rule. Anytime you have a transaction or a series of transactions that are related that adds up to more than $10,000, you got to file that form. And that it applies to cash receipts, money orders, if there's multiple money orders that are less than 10,000 but add up to more than 10,000. Why is that? You can go in and buy a $5,000 money order and not have to file a currency transaction report. And then you could buy another one and another one and another one. And now you're getting around the requirements. And so when you receive multiple money orders or cashier's checks, you have to then file a form on those. And when you have repeat purchasers, that's when it becomes questionable. And look, for those of you who are required to file the form, there's no penalty for filing the form when you don't have to. There are big penalties for failing to file the form when you do have to. So err on the side of caution here. And file these forms. They're extremely requirement, right? It's extremely important, and the IRS has got their eye on these big time. Happy to talk to anybody about these. The problem out there in the industry is that the person showing up doesn't want to give their personal information. The Marijuana Enforcement Division license card doesn't work. You got to get the information that would be sufficient for cashing a check. So that's a driver's license or a passport, really. So it's tricky. If they won't give you that information, I'll cut to the chase here. You can take that cash once. Make sure you fill out that 8,300 and put it in the memo line and explain what happened. You could do it twice, but if you do it 3 times, now whose fault is it? It's your fault. And now you're putting yourself at risk. So you need to get with the company, get them to send you somebody who will give them their information. Okay, shifting now to audits a little bit here and talk a little bit about the expertise that you need on hand during an audit. You all saw my qualifications earlier on in this presentation, and look, there's a gazillion things I don't know about audits. So it is really, really, really important to get a real professional involved in these audits. These audits are not easy. The agents are not, pushovers. They know what they're looking for. They understand the industry. They want to talk to you before you can lawyer up and do those things. And the person that you need on hand is there on the screen, CPAs, attorneys. And you as the taxpayer, you want to avoid talking to the IRS. You want your CPAs and your attorneys to do that. I'm an attorney. I've got a little bit of a slant towards that attorneys should be handling audits. I'll tell you why that is. If I'm a CPA and I prepared a tax return and I get a tough question about something on that tax return, who am I representing when I answer that question? Am I representing myself, the person who put that on the return, or the taxpayer? So it gets people in a tricky situations sometimes. And that's not to say that, good CPAs don't do good work handling audits, but everyone should think about, am I the right person to handle this audit? And I would say in the cannabis space, you, taxpayer, are not the right person to handle the audit. You need somebody to help you out. It's just so simple as to be able to have a little buffer between you and the IRS, because guess what? I can say, I don't know. That's pretty easy for me, but it's not so easy for you. And it's not so easy for the CPA either. And it's not that we're not going to give them the information they're asking for. It's that we're going to do it in a way where it's under control, rather than them just being able to ask questions out of the blue that we're not ready to answer. We might say something that might not be right, not intentionally, but just because the world's a complicated place. And now we're losing credibility. So who you need in an audit is somebody who's handled cannabis audits before. Okay, how to interact with them. Okay, really, really important. Look, there's when I started doing this stuff, there were these two different approaches out there. There was the sugar and the stick, right? And there was a great video that they showed of somebody that pounding the table and being that lawyer and all that kind of stuff, and all the horrible results that person got. And so I would just say that, look, tax officials are just people like anyone else. What they really want to do is to do their job. They don't want to hurt you, most of them. They want to just do their job. Some of them want to help you. And fighting with them and coming in, with an aggressive attitude and around, why you picking on me, jerk IRS, all that just doesn't work. That just doesn't work. That will just put them on their heels. They'll make sure they do even a better job and open up other ears. So cooperating is really, really, really important. Okay. But understanding the limits of that cooperation. You are required, taxpayer, to give them the information they're asking for if it's relevant or may lead to relevant information. And guess what? Almost everything you have in your business is relevant or could lead to relevant information. So they're entitled to get it, but that's all they're entitled to get. And so less is often more. They ask for 3 documents, you give them those 3 documents. And then you think hard about whether you need to give them some sort of a response, some sort of explanation, something like that, because again, less is often more. Back to point number 1. Why is less more? Understanding what an audit is really important. An audit ends with a proposal. And so you don't have to win in an audit. It goes on to the next step. And so an audit is just an opportunity then for the IRS to find all the issues and get them all on what's called a statutory notice of deficiency, or open up other years and other items and all that kind of stuff, and then propose the proper tax. So again, you don't have to win in an audit. And what an audit is it's a moment of exposure is what it is. And so limiting your exposure is the key goal. And you do that again by less is more, cooperation, understanding where you are in the process, understanding the authority, and making a good record, putting your responses in writing. I get a lot of calls from people that say to me things like, hey, Nick, I was talking to this IRS person on the phone and they said XYZ. And so I did that XYZ and now they say I'm wrong. Well, guess what? If it's not in writing, it doesn't count. The IRS is not bound by its verbal statements. It has to be in writing or it doesn't count. And the same thing for you. You want the things that you give to the IRS to be in writing as well, because you're creating a record and somebody's going to see that record down the road and you want that record to speak to your benefit. Let's see how we're doing on time. Kind of getting about 30 minutes in or so. We're doing good. Okay. Audit documents. Okay. What kind of stuff do we need? Okay. So they're going to ask for all books and records, right? They're going to ask for all your receipts. They're going to want invoices. They're going to want contracts. They're going to want corporate books and records, like your articles of incorporation, your operating agreements, those kind of things. They're going to want a copy of your general ledger. They're going to want a copy of your, I can't see what's the next one is there, but your point of sale, of your metric, of your sales tax returns, your excise tax returns, your bank and financial account information. All that stuff is stuff they're going to want. So you should have all of that stuff in an area that's secure. Now, look, if they don't ask for it, you don't just give it all to them, right? You give them what they ask for. But all that stuff should be readily available in electronic format is the best way as well. A couple little things around that, okay? Bank account records. You get those bank statements and they have, 8 pages and they're numbered. And one of those pages is blank. They want that page too. They want to verify that they've got all of the pages of each bank statement, okay? What are they going to use those bank statements for? They're going to use those statements to reconcile your income and make sure that in an all cash business like cannabis is, that all the income is being reported. And so they're going to look at those bank statements. They're going to compare those bank deposits to metric, to your point of sale, and to your sales tax returns. And they're going to reconcile those and they want to see that they match. Now, they rarely do. Close is probably good enough in that ball game. But they should be close. And guess what? They're going to pick the higher number generally, and they're going to try to use that number as your income. That's probably going to be, oftentimes it's metric because you're giving discounts, and those discounts are showing up maybe in your point of sale, maybe not. But they're not showing up in your metric oftentimes. And so there'll be a discrepancy there. That'll be something that we'll want to make sure that we give them daylight on. Next up, QuickBooks. Look, the IRS always wants QuickBooks. Every time they're always asking for it. And there's a big problem there. You cannot isolate the year at issue in a QuickBooks program. When you, let's say they're auditing 2020 and you got started in 2017 and you're still in business. Well, your QuickBooks file includes your entire life of your business. And you really can't pull that out of there without just deleting data. It's still in there. It still shows up. As a matter of fact, I just provided QuickBooks in an audit, and we had to delete all the data from the non-audit years, but the years are still in the QuickBooks file. You can see that there was once data there. So it's a real problem. Be really careful when you're providing these QuickBooks. The agents will say to you, look, I'm ethically obligated just to look at the year at issue. Well, I think that's true, and I think most agents will follow those rules. But guess what? I'm a lawyer. If I give them information that isn't relevant to the year at issue, does that expose me to some sort of malpractice or something like that? If they fight you on giving it to them, that's the line you use, okay? And guess what? If you give them the Excel spreadsheets instead, they've got the information. They can't take you to summons enforcement, or it's a real hard road for them to just force a QuickBooks file if they already have the information in an Excel spreadsheet. It's more difficult for them to work with, but if they already have it, then it's not a huge problem. So that's QuickBooks. Bank accounts, sales tax returns. You all should be reconciling those things in your day-to-day business with an eye towards one day having to show that you in fact did do these things right. So keep good records, get a good bookkeeper, and follow this process, because at some point someone's going to come and look. Okay. This gets a little tricky, right? So how do you get a good result with the IRS short of going to trial, which has not been good for the industry? Number one, you work with the IRS. Eventually, you're going to get to a point where you're going to be talking about something called hazards of litigation, and that's your optimum time to settle. It doesn't happen in the audit. So an audit is very much by the book. You either get it or you don't, and there's sort of not much middle ground generally in audits. As you move forward in the process, you encounter IRS personnel whose responsibility then it is to think about what are called hazards of litigation and what the IRS's chance of success would be if they went to court. And if you have sort of some information, but not all of it, you can get to a place where perhaps you can show that even though you might not have that document that they wanted in the audit, you have substantiated the expense, in this case, cost of goods sold, because you have other stuff, right? And that occurs later on in the process. So what is that process? So first you have an audit. That audit ends with what's called it starts concluding with what's called a 30-day letter. A 30-day letter is an administrative proposal for the results of the audit. And a 30-day letter gives you a right to go to an administrative appeal. An appeal is a right that taxpayers have at various times in like a life cycle of a tax liability, from filing it to collecting it. There are these appeal rights that show up. And essentially the IRS Office of Appeals' job is to settle cases, to resolve controversies. And so their job is to think about hazards of litigation and to weigh things. I think you got a 40% chance to prevail here, Mr. Taxpayer. We'll give you a 40% settlement. So that's their job, is to do that kind of stuff. And you get, when you have a tax liability after an audit, or when you have an audit result, you get two chances. The first chance is on this 30-day letter, and that's an administrative appeal. You're going to have to extend the statute of limitations for that, meaning the time that the IRS can still make an assessment against you of additional tax. They will make you extend that while that appeal is ongoing. And the audit technically stays open during that appeal. Why is that important? Once the statutory notice of deficiency is issued, that's the next document that I'm going to talk about, that concludes the audit, and it frames all the issues in that statutory notice. Everything that is in that notice, it is the taxpayer's burden to prove the IRS wrong. Anything that's not in that notice, it is the IRS's job to prove the taxpayer wrong. So that notice is really important. It frames the issues, it locks them down, right? And generally, once you get those issues on that statutory notice, the IRS doesn't add additional issues because it would bear the burden of proof on those additional issues. Well, guess what? Let's go back now. So that's the general dynamic. Now you file this 30-day letter, you have to extend that statute. The audit's still open. So now if they find new issues, they can add them in to the audit. And now you bear the burden of proof to prove them wrong. Oh, and guess what? That appeals officer is a former IRS agent. And so their job is also audits. And so if there's something that IRS audit missed, they're going to find it. So that's a 30-day audit. Now, differently, if you say no to the 30-day audit, you don't have to extend the statute of limitations, and they're going to issue what's called a statutory notice of deficiency. That statutory notice of deficiency then gives you the right to go to tax court. And in going to tax court, then, if you didn't go to appeals on the 30-day letter, now you get to go to appeals. Why is that better? Number one, burden of proof. We talked about that. Number two, if you go to appeals on a 30-day letter, you have to write up a protest. That's a very expensive document. And guess what? The IRS agent gets to rebut it in writing. But if you go to tax court first, a tax court petition is a very inexpensive process. And now you're before IRS appeals. You didn't have to write the protest. The revenue agent didn't get to rebut it. And the statute of limitations has closed on all of the other issues that are out there. And guess what? There are no hazards of litigation if you are in an administrative appeal, because you're not in litigation. And guess what? The appeals officer knows full well that you have to go out there and file a new document and spend more money to get into litigation. So the idea that there's hazards in that administrative appeal is a little tough. Now, that said, I'm not saying it's always best to go the route of a statutory notice and to go to tax court first. Sometimes there's good reason to go on an administrative appeal, but it's something that's really, really important to understand. And it is critical if you get good audit results, but there's something you want to challenge, but there was something that is missed. Really, really, really important. And finally, I've got collections up on the board as well. You can settle an IRS matter all the way along through the process. The process starts with an audit, then there's tax court, then there is collections. And in collections, you can settle tax debt for ability to pay. So you're an individual, you're a company, you don't have the ability to pay your taxes. You can get into a resolution that could end up getting you satisfying those taxes without paying them in full. Those settlements oftentimes taxpayers bring those up during audits, but the IRS is generally not wanting to talk about, hey, I can't pay this during the audit, they will say, look, okay, great, accept our results and go work with collections. And guess what? Sometimes you do that. Sometimes you say, look, we don't care. Go ahead, assess as much tax as you want. This person doesn't have a dime. They're never going to pay any of it. They're going to get out of this. So do what you want to do. That is sometimes a valid exit of an audit. So understanding that whole process then is critical in knowing how to settle a case, any case, cannabis case or non-cannabis case. And understanding when it is critical to settle and not is really important, because if you settle during an audit, there might be some things that you get in that audit that you might be a very good reason to settle in that audit. Sometimes in audits, you can get the auditor to agree to not allow certain adjustments, or to allow certain adjustments that they would then disallow if you didn't get them an agreed audit case. You see that less and less out there now, actually. But sometimes you can get a good deal in an audit, sometimes not. Understanding then how you go get that deal from IRS appeals is really, really important. And not throwing away your appeal on a 30-day appeal is really, really important as well. And before we move on to questions, I'll just say these appeal rights come up on a number of different situations. I want to just say real quick, it's not audits, but down to collections. Appeal rights come up through something called a CAP, a collection appeals process. That's like a little mini appeal. It's like a little timeout, but more importantly, there's something called a collection due process hearing. It's known as a CDP hearing. And a CDP rights are sort of a timeout from collections to work out a resolution to a tax liability. And they arise in two main places. Number one, CDP comes up after a notice of federal tax lien is filed. So if you have a tax debt, a tax notice of federal tax lien gets filed, and now you have 30 days to request a CDP hearing on that matter. Differently, if they want to take your money, IRS has two powers. They can file liens and they can take your money. If they want to take your money, they have to give you 30 days notice before they take your money. A lien, it comes after they lien. With a levy, that's taking your money, it comes before. And so you can tie up the IRS's levy powers and work out a resolution with them through the CDP process. And that is an administrative process that can be used to get current with your tax obligations and get into a managed tax liability. What's the price of that? The price of that is the statute of limitations on collections, which is 10 years from the date of assessment, is told while that CDP hearing is pending. That's the time is the price that you pay for that CDP hearing. That statute is also told whenever you have a offer and compromise that you've submitted or an installment agreement that you've submitted. And I think, Cassie, is that yep, there I am. I believe that's our last slide. Did I bring us in on time?
Yes, that was perfect. Thank you so much, Nick. What a great presentation and fantastic info. As you can see here, attendees, please reach out to Nick if you have any additional questions. But in the meantime, we have a few minutes here, so let's ask a few. I've been jotting down a bunch here while you've been presenting. And folks, if you have any questions for Nick, type them into the Q&A box or the chat box here, and we'll try to get to as many as possible before the event concludes. So the first question, and please forgive me if I'm not asking this correctly, someone had posed the question, could the fact that cannabis finances are not insurance eligible have a part in the distinction of COGS? Am I asking that correctly?
Yeah. Gosh. So the fact that cannabis finances, ask it again, are not eligible for COGS.
The question was posed.
First off, I would challenge that initial assertion. I think cannabis financing can be eligible for COGS. It depends on what that's for. And so there's a distinction between production assets and reseller assets. Production assets can be put into COGS, reseller assets cannot. But I don't know that I'm not sure what the questionnaire is driving at, meaning because some part of it isn't subject to cost of goods sold, I'm not sure what that would lead us to in that question.
Sure thing. If the attendee could clarify, we can try to circle back to that one really quickly at the end. Another attendee posed the question, are flow-throughs also incurred by the investor on K1s as well, in addition to the owner? And will they be subject to LUQs?
Okay, so if an investor receives a K1, they are an owner. So owners get K1s for partnerships, and sometimes investors are lenders, sometimes they're owners, sometimes they have convertible interests. If their interests are not yet, ownership interests, then no, they do not get flow through 280E liability. If you receive a K1 though, you are an owner and you are receiving flow through 280E liability, assuming that it's there and that it's being reported and all that. And will they be subject to LUQs? Yes, if you are an investor owner and you're receiving a K1, you will receive what's called the question is, do they just survey your return, or do they do a full audit? A survey is where they just kind of take a look at it and kind of go, yeah, okay, there's nothing really needed to look on there. They'll do that. They'll be looking for those LUQs. And then they will, if they see those LUQs, then they are required to open up those and audit just those. And if those expand them to other years and other issues, then they open up those as well. I would say that classic issues out there that could lead investors into trouble are offshore stuff, offshore bank accounts, offshore businesses and trusts and stuff like that. Any of the other kind of, if you have other kind of interesting businesses out there that have complicated tax effects, employee leasing, things, other tax shelters, things that look like that, that'll get you picked up right away for these audits for sure.
Thank you so much for clarifying. Our next question, do insurance companies have to file a Form 8300 when receiving premiums from a cannabis insured company?
They would, if they're receiving more than 10,000 in cash, they would have to file a Form 8300. Yeah.
Okay.
Unless they also some insurance companies do more than just insurance. Some of them might have some sort of additional requirements because they are a money transmitter or those kind of things.
Perfect. Okay, the next question here, should cannabis business operators consider a third-party inventory audit to reconcile their product quantities from their physical inventory to the POS metric system?
Bobby, I like that. I think the more support we can get, the better. There could be a number of good reasons to do that aside from taxes. I don't know if it needs to be a third-party inventory audit. Certainly that looks better. If I was concerned about, having to use the audit for something other than internal, just normal stuff, I would definitely use a third party. But I think just an internal audit can also be okay. But yeah, I think that's really important. A number of things come up on my end on that. Certainly that reconciling all those different data sources is important, and the IRS is going to do that itself. But catching theft and that kind of stuff can be useful. This could be useful for that as well. Here in Colorado, they talk about shrinkage, and how much the plant shrinks in weight from whole plant wet to whole plant dry, and they would claim that they know those averages, and they would know if there's marijuana going out the back door because of the differences there. And so it would seem to me that these internal audits can be useful for other things like that as well.
Perfect. Another attendee has the question, if you could please revisit the NOL or the net operating losses. Yeah. Are NOLs now available to cannabis businesses?
Yes. NOLs are available to cannabis businesses if they're properly determined in the source year. So for example, in that real simple example I gave with buying one joint, let's say, is that a good example? There's probably some technical things that some CPAs are going to reach out and say, Nick, what about this? But I'll do it anyway. I buy one joint. Let's say I pay $4 for the joint, $2 to sell it, and I still sell it for $5. I just lost $1. And so even though I still get taxed in that example on $3, I legitimately lost $1 because my cost of goods sold are $4, or however that math works. But once you get to an actual gross margin loss, I guess is the accounting term for it, that's a true loss. That NOL now can be carried forward. I would be happy to talk to anybody individually about that. I've written some opinions on that for MSOs that have NOLs, and happy to support anybody on that. There's a lot of good law around outside of 280E why that should be allowed. And I think Cassie, that James must have, that net operating losses he put in the chat here, and I wonder if that's what he wanted me to qualify on lending not being deductible. I think that's an interesting question. And so meaning if you, I mean, I'm not, again, if it is a legitimate NOL generated in the source year, then yes, it can be carried forward. On startup costs and investor costs, I think what that means is that if those investor costs are subject to 280E because they're in a dispensary, and notice I said if, that in that case, they would not be part of the NOL carry forward, they would be then part of the disallowed 280E costs. Now you're going to say, James, wait a minute, what about that alternative healthcare case that said that 280E didn't apply during startup? Wouldn't that also apply to non-production assets? And that's the big question out there that we don't know the answer to yet. And I think that's one that's worth pursuing. Eyes, wide open, understanding, that there's exposure there. But that's a question I've been asking as well. If it's not subject to 280E in the first place, wouldn't we then be able to, I don't even want to say the word, deduct it moving forward? So yeah.
Absolutely. I think we have time for one or two more questions. So let me ask this one here. How much can one expect to invest financially in an audit?
Yeah. So, the audit itself, most of the audits that I handle are in that, I don't know, I'd say sort of $5,000 to $15,000 range for the audit. Bigger companies are obviously more difficult and they take more time. I saw a figure today that said that for every tax return and year that the IRS audits, it takes them something like 48 hours. So, they spend a full work week, right, on the audits. And so it's, audits can be expensive. They can also be very inexpensive. If you just go to the next phase. Most of my clients in the cannabis space, that we start out with an audit and then we work through that while we're trying to get current, because there's going to be probably a liability of some sort. If there isn't already one out there, oftentimes there is. And so we're trying to move through a process where we are trying to get current. And usually that means moving towards the future. So not paying the debt now, and then getting ourselves to a point where we can manage the debt and then pay our current taxes as well. And so kind of an audit can oftentimes be more than just the audit, right? Because you kind of got to get through the whole process. If you could pay it at the end of it and you want to do that, great. That makes it a lot cheaper. But if you want more time and you want to kind of grow your business during that time and get to someplace down the road with the IRS and then get into a payment, that takes more procedures and more stuff like that, and that gets more expensive.
Gotcha. Thanks for clarifying.
Sure.
And I want to ask one more question. How would the SAFE Banking Act change the landscape? And if SAFE were passed, how quickly would other regulations change?
Yeah. Well, so I think, the Safe Banking Act doesn't change 280E, and it doesn't deschedule cannabis. So a loan providing for safe banking doesn't do anything for 280E. It would effectuate what it would do, though, is it would open up lending to cannabis companies in a lot of ways, which would enable cannabis companies maybe to deal with 280E in a better way. It would make capital come in a better way as well. So it has a lot of positives, but I don't think 280E it would be going away from the Safe Banking Act. And Cassie, let me say this: I think that it is not. It would be great for the industry if 280E just went away. Obviously, every company out there would make more money. But it is not an effective business plan to be, planning for that day. Every legalization bill that I've ever seen comes with taxes, and whether that's at the state level or at the proposed bills that we have seen at the federal level all carry taxes. And the Schumer bill carries a tax rate that's could be worse than 280E for many. So I don't think thinking about the sort of pot of gold at the end of the rainbow works well in a business sense. I don't see it happening. I don't see it going away anytime soon. Let me say this though, Cassie, there is something afoot out there. About a year ago, there was a case that was denied cert trying to challenge the constitutionality of 280E. And after that case came out, Supreme Court Justice Thomas stated that a case called Gonzalez v. Raich needs to be revisited. Gonzalez v. Raich held that cannabis could remain a Schedule I controlled substance despite California legalizing it because the federal government needed uniformity in order to enforce the Controlled Substances Act. Well, Justice Thomas said, hey man, there's no uniformity out there. What are you talking about? We should revisit Gonzalez v. Raich. May not be a good basis anymore. So I do believe that there has been some announcements about that. There's a group going forward to try to challenge the scheduling of cannabis. That, if it won, would remove 280E if cannabis was descheduled or moved to a Schedule III controlled substance.
Well, thank you so much, Nick. We really appreciate you sharing this amazing presentation and your expertise and your insights on this really important topic for cannabis operators.
Really fun to speak to you in the group. Cassie, thank you so much. Have a great Tuesday.
Absolutely. And Nick, if you could stop sharing your screen for just one moment, I just want to make sure that our attendees get this code.
No, I have control.
Yeah, absolutely. So I just want to remind everyone that Cannabis Conference 2022 will be taking place at Paris, Las Vegas from the 23rd through the 25th of August. We really want to make sure that everyone here gets our discount code. Tomorrow at midnight, our early bird rates expire where you can save up to $400 off on-site pricing. So if you want much more education in person just like this, make sure you register. If you're here on the webinar today, you can use this special webinar promo code. It's Audits 10. If you use that by tonight at midnight, you'll receive an additional 10% off of those early bird rates, plus groups of 3 or more save an additional 15%. So lots of ways to save on your registration there. We're looking forward to hosting about 4,000 attendees in the industry's biggest event for plant touching businesses. So again, Nick, thank you for your time. Thank you attendees for joining us today. We hope you have a great rest of your week and come away smarter.
Thank you.